something happened on July 15th, 2026 that honestly made me stop what I was doing. At first, I almost ignored it because we have heard the word tokenization so many times now that it has started to lose meaning. Every few weeks, somebody announces that they tokenized a building, a bond, a piece of art, a mineral, or some random asset. Nobody was asking to trade on a blockchain. The announcement gets some attention. People use words such as revolutionary, and then we never hear about it again. So when I first saw the July 15th announcement that QQQ had been tokenized, my initial reaction was basically, okay, interesting, but probably another experiment. Then I saw who was behind it, DTCC. And that changed the story for me because this was not some unknown crypto company creating a token that follows the price of QQQ. JP Morgan took the Invesco QQQ ETF, ticker QQQ, and converted it into a tokenized representation inside infrastructure connected to DTCC, the institution already sitting behind a massive part of the US financial system. Then SPY was tokenized, then US Treasuries moved on-chain, then tokenized assets were used as collateral at CME Group, then firms started exchanging treasuries, stocks, and ETFs against digital cash. And by the end of the event, around 40 institutions had participated in real production transactions involving collateral, repo, securities lending, cross-chain transfers, and settlement. Not just crypto companies. We are talking about JP Morgan, Goldman Sachs, BlackRock, Citadel Securities, NASDAQ, the New York Stock Exchange, CME Group, State Street, Vanguard, Circle, Microsoft, Chainlink, and many others. That was the point where I thought, okay, this may actually be a much bigger story than QQQ is now on a blockchain. Because the obvious interpretation is that Wall Street is finally joining crypto. I do not think that is what is happening. I think the opposite may be happening. I think Wall Street is absorbing crypto. It is taking the useful parts, the programmability, the faster movement of assets, the shared record keeping, and removing the parts institutions do not want. The anonymity, the lack of control, the inability to reverse mistakes, the idea that nobody is legally responsible when something breaks. And there is another piece to this story. At the same time that stocks and treasuries are beginning to move on-chain, the US government is openly promoting regulated dollar stablecoins. Treasury officials are saying these digital dollars could expand access to the dollar economy, strengthen the dollar's global position, and create more demand for US government debt. So now look at what is happening. Dollar cash is moving on-chain through stablecoins. Treasuries are moving on-chain. Stocks and ETFs are moving on-chain. Collateral is moving on-chain. Those developments look separate when you read the headlines one at a time. I do not think they are separate. I think the United States may be building a new operating system for the dollar. Stable coins become the digital cash. Tokenized treasuries become the digital collateral. Tokenized stocks become the digital assets, and institutions such as DTCC become the trusted ownership layer, connecting all of it to the legal financial system. For years, people believed blockchain would weaken or replace the dollar. But what if blockchain does the exact opposite? What if it gives the dollar access to every internet-connected wallet in the world? And what if the technology created to bypass banks becomes the technology banks use to modernize themselves? That is the story I want to explore in this video. And yes, later in this video, we are also going to talk about DVLT. You guys know I follow Datavault AI closely. I am invested. So I have a bias here. I want the tokenization thesis to be real. I want Datavault to succeed. But I also do not want to lie to myself just because I own the stock. DTCC did not mention Datavault in this event. There is no direct connection that I can prove right now, but this development may still matter enormously for the category Datavault says it is building around. We need to separate those two things, the tokenization market becoming real, and one specific company proving that it can capture value from that market. Those are not the same thing. And by the end, I want to show you exactly what I think Datavault now has to prove. But first, we need to go back almost 60 years. I know, we started with QQQ on July 15th, and now I am taking you back to the 1960s. But stay with me because this whole story started when Wall Street almost collapsed under the weight of paper. Hi, everyone. Welcome back to GoGlides Finance. You came here for a stock market story. Unfortunately, we first need to rebuild the entire financial system. So let us get into it. In the late 1960s, the American stock market had a very strange problem. Too many people were trading. Normally, that sounds great. More investors, more transactions, more commissions. Everybody should be happy. But at the time, stock ownership still relied heavily on physical certificates. When somebody purchased shares, a certificate had to be found. It had to be endorsed, it had to be verified, it had to be transported, the records had to be updated, and then it had to be delivered to the correct broker or custodian. Now imagine doing that for millions of transactions. Trading volume started rising faster than Wall Street's back offices could process the paperwork. Stock certificates disappeared, trades did not match, records became confused, transactions failed to settle. Brokerage employees worked nights and weekends trying to figure out who owned what. And the situation became so bad that the New York Stock Exchange had to shorten trading hours and close on Wednesday afternoons just to catch up. Think about that. The stock market had to take Wednesday afternoon off because there was too much paper. It was basically saying, sorry, no more trading today. We are still looking for Tuesday's certificates. This became known as the Wall Street paperwork crisis, and the solution was actually very simple. Stop moving the certificate. Instead of physically transferring stock certificates every time ownership changed, the industry created a central depository. The certificates could remain immobilized in one trusted location. Then ownership could change through electronic book entries. The physical asset stayed in one place. The ownership record moved. That system eventually became part of the foundation of modern DTCC infrastructure. And honestly, when I understood that history, something clicked for me, because that was already a form of tokenization, not blockchain tokenization. There was no crypto, no smart contract, no token symbol, but the basic idea was similar. You take a physical or difficult to transfer asset, you place it inside trusted custody, and then you allow an electronic representation of ownership to move through the financial system. The certificate became less important, the ownership record became more important. DTC turned stock ownership into data, and that helped Wall Street scale. Now remember this, because it is important. The company did not change. The investment did not change. The Coca-Cola stock certificate still represented Coca-Cola. What changed was the infrastructure recording and transferring ownership. And that is essentially what happened with QQQ. QQQ did not become a cryptocurrency. The companies inside QQQ did not change. The asset did not suddenly become more valuable because somebody used a blockchain. What changed was the form in which ownership could be represented and moved. Same underlying asset, new movement system. History is repeating itself, but with newer technology. And that brings us to the first real problems tokenization may solve. Because the stock market looks instant, but underneath the screen, it is not nearly as instant as it feels. You can open your brokerage app, press buy, and receive a confirmation in less than a second. To you, the transaction looks finished. You bought the stock, the shares appeared in your account, done. But behind the screen, several different institutions may still need to complete their parts of the transaction. The exchange matches the buyer and seller. A clearing organization calculates obligations. Your broker updates its record. The other broker updates its record. Custodians update their systems. Banks move cash. The central depository updates securities positions. And all these organizations need to make sure that their databases agree. The United States moved to T+1 settlement in 2024. That means most stock trades officially settle one business day after the transaction. That is a big improvement. But think about what it means. We can match the trade in a fraction of a second. The final movement of the asset and money can still take until the next business day. It is a little strange. The front end feels like 2026. The back end sometimes still feels like several systems emailing spreadsheets to each other. And during that gap, institutions have risk. What happens if one party fails? What happens if prices move? What happens if the collateral needed for one transaction is sitting inside another institution's system? To protect against that risk, the financial system requires margin, guarantees, capital, and reconciliation. That costs money. Now, I do not want to oversell this. Blockchain does not magically solve everything. And instant settlement is not automatically better for every transaction. Large institutions sometimes benefit from netting many trades together before settling them. So the real story is not simply blockchain makes everything instant. That is too simplistic. But tokenization does create a different possibility. The asset, the cash, and the transaction instructions can potentially interact in the same programmable environment. The payment and the security can move together. Either both sides complete or neither side completes. And this is why I think the most important part of the DTCC event may not have been QQQ. QQQ is what gets our attention. Everybody recognizes QQQ. But the thing Wall Street may care about more happened when tokenized assets were moved to CME Group to meet margin obligations. That is collateral. And the collateral piece is where I became much more interested. Imagine you own a valuable asset, but you cannot use it when you need it because it is sitting inside the wrong system. You are not short of assets. Your asset is simply stuck. Financial institutions deal with a much more complicated version of that problem. They may own billions of dollars of treasuries and other high-quality securities. But those assets may sit inside different custodians, legal structures, time zones, and technology platforms. An institution can be wealthy on paper and still need to find the right collateral at the right place at the right moment. Tokenization may allow approved assets to move more continuously between institutions and networks. A treasury could move into a collateral arrangement. A smart contract could confirm the required conditions. The collateral could be returned when the obligation ends. More of that process could become coordinated and automated. And that is why I think everybody talking only about 24-hour stock trading is missing the bigger opportunity. Yes, buying Apple stock on Sunday sounds nice. But how often do ordinary people desperately need to buy Apple at 3 in the morning? The larger financial opportunity may be helping institutions move billions of dollars of collateral more efficiently. Retail trading is the exciting headline. Collateral is probably where the serious money is. But that creates another problem. If the asset moves digitally, the money also needs to move digitally. And to understand that side of the story, we need to go back to 1944. Now, I know we are jumping from QQQ to Bretton Woods, but this connection matters. Because to understand why the US government cares about digital dollars today, we need to understand how the dollar became the center of global finance in the first place. In 1944, the Second World War was still happening. Representatives from 44 countries gathered in Bretton Woods, New Hampshire, to design the financial system that would exist after the war. The United States was in an incredibly strong position. Europe had been devastated. America had become the world's dominant industrial power, and the United States controlled a huge share of the world's monetary gold. Under the Bretton Woods system, major currencies were linked to the US dollar. The dollar, in turn, could be converted into gold at $35 per ounce by foreign monetary authorities. That made the dollar the center of international settlement. Countries traded using dollars, central banks accumulated dollars. And they trusted the dollar partly because it could ultimately be exchanged for gold. Let us call this dollar 1.0. Dollar 1.0 was the gold-connected dollar. But the system had a contradiction. The world economy was growing. Trade was growing. Countries needed more dollars. To provide more dollars to the rest of the world, the United States had to send dollars abroad. But the more dollars that existed outside the United States, the harder it became to maintain confidence that all those dollars could still be exchanged for gold at the official price. The United States had created more dollar claims than it could realistically redeem in gold. Basically, it had sold more tickets than there were seats. And in August 1971, President Nixon closed the gold window. Foreign governments could no longer exchange their dollars for US gold at the fixed rate. Now, here's the interesting part. The dollar did not disappear. It became even more important. Why? Because by that point, the dollar was no longer valuable only because of its gold connection. It had become valuable because of the network surrounding it. After 1971, the dollar became the operating system of global finance. International trade used dollars. Commodities were priced in dollars. Banks borrowed and lent dollars. Central banks held dollar reserves. And global investors purchased U.S. Treasury securities, corporate bonds, and stocks. If a country earned dollars from selling goods, it needed somewhere to store those dollars. The Treasury market gave it a place. If a company needed to raise huge amounts of capital, the American financial system offered investors, banks, exchanges, and legal protection. The dollar was no longer supported by one fixed promise to convert it into gold. It was supported by an enormous network of financial usefulness. Let us call this dollar 2.0. Dollar 2.0 was the financial market dollar. People used dollars because everybody else already used dollars. Everybody else used dollars because the markets surrounding the dollar were larger and more liquid than the alternatives. That is a network effect, and network effects are incredibly powerful. A currency is not only money, it is access. Access to trade, access to financing, access to safe assets, access to investment markets. And now, I think the United States is attempting to build dollar 3.0. The funny part is that the technology may come from an industry created to escape the dollar. The original crypto story was rebellion. No central bank, no government, no bank account, no trusted intermediary, no institution controlling the ledger. Bitcoin was supposed to offer money outside the traditional system. Ethereum introduced programmable digital assets. Thousands of cryptocurrencies followed. Some were serious experiments. A lot were basically casinos with logos, but one product became genuinely useful across the crypto economy: stablecoins. Why? Because people using crypto still needed dollars. They needed something that could move across blockchain networks without dropping 15% while they were eating dinner. So stablecoins became internet-native representations of traditional currency, mostly the US dollar. And by 2026, the stablecoin market had grown into hundreds of billions of dollars. Still small compared with global banking, but far too large to dismiss. Then the US government saw the opportunity. A regulated dollar stablecoin does not have to be only a tool for crypto traders. It can be a global dollar distribution system. The Genius Act created a federal framework for regulated payment stablecoins. The basic idea is that an issuer creates digital dollars and backs them one for one using qualifying reserve assets such as cash, deposits, and short-term U.S. government securities. And Treasury Secretary Scott Bessent openly described stablecoins as an internet-native payment rail for the dollar. He argued that they could expand access to the dollar economy, support dollar dominance, and increase demand for U.S. Treasuries. He was not being subtle. This is not simply about making cryptocurrency safer. This is about extending the dollar network. Think about how it works. A person outside the United States wants digital dollars. They purchase a stablecoin. The issuer receives traditional money. The issuer holds qualifying reserves, potentially including short-term treasuries. The customer receives a digital dollar inside a wallet. The treasury market potentially receives another buyer. And the dollar reaches someone who may never open an account at an American bank. That is the part I think people are underestimating. For decades, distributing dollars internationally depended heavily on banks. Now, the distribution layer can potentially be a wallet on a phone. Crypto spent years building the highway. The US dollar may be arriving with the largest truck. So I do not believe America suddenly became a crypto believer. I think it realized stablecoins could help export the dollar. That is the beginning of Dollar 3.0. But stablecoins alone are not a complete financial system. Digital cash needs somewhere to go. And that brings us back to QQQ. Suppose you hold a dollar stablecoin. You can send it, you can receive it, you can use it as cash. But what happens when you want to invest? Can you purchase a treasury directly? Can you purchase QQQ? Can you use that treasury as collateral? Can the asset and payment move at the same time? Can the ownership rights move safely across different networks? This is the missing part. Stablecoins provide digital cash. Tokenized treasuries provide digital collateral. Tokenized stocks provide digital investment assets. But none of it works at serious scale unless people trust the connection between the token and the actual asset. Because creating a token is easy. I could create something today and call it tokenized QQQ. That does not mean I own any QQQ. It does not mean you receive dividends. It does not mean you can vote. It does not mean you have a legal claim against the underlying shares. It could simply be an IOU attached to the price of QQQ. This is one of the biggest problems in tokenization. The token looks real. But what does it legally represent? Who owns the actual asset? Where is it held? Can you redeem it? What happens if the token issuer goes bankrupt? The SEC has already made this distinction clear. Some tokenized securities may provide real ownership interests. Others may be third-party products that offer indirect or synthetic exposure. Two tokens may look almost identical inside an app. One may represent legitimate ownership. The other may be a promise from a company that could fail. One is a digital asset. The other may be an IOU wearing an asset costume, and that is why DTCC changes the equation. DTC already holds the traditional securities. It already sits inside the legal ownership infrastructure. The DTCC service allows eligible assets held within that system to move between traditional and tokenized forms. The tokenized version is intended to retain the same legal and economic rights as the traditional asset. That is the real breakthrough, not that somebody created a token called QQQ. It is that the institution already connected to the official ownership system created the tokenized representation. Remember the paperwork crisis. The industry solved the first problem by keeping the physical certificate inside a trusted depository and moving electronic ownership records. Now it is taking assets inside the depository and allowing approved digital representations to move across blockchain networks. Same basic idea, different technology, and the timeline is moving much faster than I expected. In December 2025, DTC received regulatory no-action relief covering a tokenization service. In January 2026, the SEC explained how existing securities laws apply to different tokenized structures. In May, DTCC said more than 50 firms were helping build and test the service. In July, roughly 40 institutions completed real production transactions, and the commercial service is expected to launch in October 2026. That is not a vague roadmap, that is regulation, production testing, institutional participation, and a launch target. Now, I'm not saying the entire U.S. stock market moves on-chain in October. It will not. This will start slowly. A limited number of approved institutions, a limited group of liquid assets, treasuries, major ETFs, Russell 1000 companies. But infrastructure changes usually look boring at the beginning. One approval, one integration, one transaction, one asset, one custodian, then another. And years later, everybody acts like the outcome was obvious. Now, this is where some crypto investors may be disappointed. DTCC's version of tokenization is not truly permissionless finance. The tokens can include controls, assets may be frozen, transfers may be reversed under certain conditions, wallets may need approval, identity may be monitored, transactions can be paused, the ownership record can be reconciled with the traditional system. So this is not the crypto dream of nobody controls my assets and no institution can touch them. This is more like the asset moves using blockchain technology, but the institution still has the administrator password. And honestly, I think that is the only version large financial institutions were ever going to accept. Imagine telling a pension fund, sorry, your $800 million treasury transfer went to the wrong address, but code is law. That is not going to work. Institutional finance needs identity. It needs dispute resolution. It needs court orders. It needs sanctions compliance. It needs someone legally responsible when the software fails. So I see two possible tokenized futures. The first is the decentralized dream. Open networks, personal wallets, minimal intermediaries, assets moving freely across protocols. The second is programmable Wall Street. The same major institutions remain in control, but ownership records, payments, collateral, and compliance become more connected and automated. My personal opinion is that programmable Wall Street wins first. Wall Street will use blockchain. But most investors may not even realize it, and that may actually be the sign that tokenization succeeded. When people stop calling it tokenization, it is simply how the asset moves. Now we get to the investment question. Because saying tokenization will become enormous is easy. Figuring out who gets paid is much harder. Every major trend creates companies that suddenly rename themselves around the trend. During the internet bubble, every company became an internet company. During the AI boom, every company found artificial intelligence inside its business. Tokenization will be the same. Somebody will tokenize a sandwich and issue a press release before lunch. So I do not want to invest based only on who says tokenization the loudest. I want to find the control points. The first is custody. Who holds the underlying asset? The second is legal ownership. Who maintains the official record? The third is identity and compliance. Who confirms that the buyer is allowed to own the asset? The fourth is settlement. Who connects the cash to the asset transfer? The fifth is collateral. Who allows the tokenized asset to be used in lending, repo, and margin transactions? The sixth is liquidity. A token with no market is just a database entry. The seventh is interoperability. Can the asset move between different systems without creating multiple disconnected versions? And the eighth is verification and data. This part interests me the most. QQQ is relatively easy. The asset already exists. DTC already holds the securities. The market price is visible. The ownership rules are established. But what happens when the token represents something outside the traditional stock market? A gold deposit, a building, a patent, a royalty stream, medical data, carbon credits, minerals underground. Who proves the asset is real? Who proves the seller owns it? Who values it? Who updates the information? Who prevents the same asset from being tokenized 2 or 3 times? That is where tokenization becomes a data and verification problem. And that is where smaller companies such as Datavault AI may have an opportunity. Let me be transparent here. I own DVLT. I follow the company closely. So yes, I naturally look for connections between developments like this and the Datavault thesis. That is my bias. But owning the stock also makes me more demanding, not less. Because I do not want to become the person who takes every tokenization headline and immediately says, this is bullish for Datavault. That is not analysis. DTCC did not use Datavault for the QQQ transaction, at least not based on anything disclosed. Datavault was not named. There is no direct partnership I can point to, so why do I still think this matters? Because the category Datavault has been talking about is moving from theory into real institutional production. For a long time, one of the biggest questions around companies like Datavault was, is this market actually going to exist? Are serious institutions genuinely going to tokenize real assets? We now have an answer, yes, they are doing it. The next question is much harder. Does Datavault own anything that institutions will actually need and pay for? Datavault describes its technology as helping verify, value, tokenize, and monetize physical and digital assets. The company talks about data valuation, digital twins, asset authentication, licensing, token exchanges, intellectual property, commodities, real estate, data marketplaces. Those areas potentially overlap with the parts of tokenization that become more difficult outside traditional securities. DTCC already understands QQQ, but QQQ has an existing depository, exchange, price, ownership structure, and legal framework. A piece of intellectual property does not. A mineral deposit does not. A private data set does not. Those assets need verification, valuation, ownership information, data rights, and potentially a marketplace. That is the layer Datavault says it is building. So yes, I see the July 15th DTCC event as a tailwind for the broader DVLT thesis. Not because Datavault was involved, because the market it has been positioning for is becoming more credible. But now the pressure on Datavault becomes much greater. The company has announced very large contracts and projected fees. But its current financial statements still show a very small business compared with the future being described. And this is the part that worries me. There is a huge distance between announcing the value of assets connected to an agreement and collecting actual cash for providing a useful service. I need to see recognized revenue. I need to see customers paying. I need to understand the margins. I need to understand whether revenue is recurring. I need to know whether Datavault earns an upfront licensing fee, a transaction fee, a percentage of asset value, or some other economic interest. I need to see activity. Assets issued, transactions processed, customers returning. Because a small company can identify the right future and still fail. It can have patents and fail. It can sign agreements and fail. It can build technology and fail. It can dilute shareholders so heavily that the business grows while each share captures very little of that growth. That is the risk. So my view is still bullish, but it is not blind. QQQ moving on-chain tells me the theme is real. It does not tell me Datavault is the winner. Datavault has to prove that. The biggest bear case is not that tokenization disappears. The biggest bear case is that tokenization succeeds, and the largest institutions capture almost all the money. DTCC already controls the securities infrastructure. JP Morgan already has institutional customers. BlackRock already controls trillions of dollars of assets. NASDAQ and the New York Stock Exchange already have liquidity. State Street and BNY already have custody relationships. Circle already has stablecoin distribution. Large blockchain networks already have technical integrations. So the tokenization market can become enormous, while smaller public companies capture almost none of it. That is possible. And investors in DVLT need to take that seriously. There are also technical risks. Liquidity may fragment between traditional and tokenized markets. Different networks may create incompatible pools. Smart contract bugs may automate mistakes. Stablecoin runs may create pressure on reserve assets. Investors may purchase tokenized products without understanding whether they own the underlying security. And faster settlement may sometimes require more liquidity, not less. Technology does not eliminate financial risk. It moves the risk somewhere else. But personally, I do not think those problems stop the transition. I think they shape the type of system that wins. And the winning system will probably be more regulated, controlled, and permissioned than crypto purists want. That may not be the philosophical revolution people imagined, but it can still be a financial revolution. So how do we know whether this thesis is actually developing? The first thing I am watching is the expected DTCC launch in October 2026. Does it happen on schedule? Which assets are available? Which institutions move from testing into repeated usage? The second is transaction volume. A successful demonstration is important. A system processing meaningful recurring volume is much more important. The third is collateral. I want to see whether tokenized treasuries begin appearing more often in repo, margin, and derivatives transactions. I believe collateral mobility may be the first major institutional use case. The fourth is stablecoin growth. Does stablecoin adoption create new demand for dollars and treasury bills? Or does it mainly move existing dollars out of banks and money market funds? The fifth is interoperability. Can legally recognized assets move safely between different networks without creating duplicate ownership or fragmented liquidity? The sixth is investor rights. Whenever a company says tokenized stock, we need to ask, do I own the actual security? Do I own a custodial claim? Or do I own a synthetic promise? Those are not the same thing. And the seventh is the most important for investors. Who is collecting real revenue? Who gets paid when the asset is issued? Who gets paid when it is verified? Who gets paid when it moves? Who gets paid when it is used as collateral? Who gets paid every time it trades? For Datavault, my dashboard is simple. Recognized revenue, cash collected, gross margin, assets actually tokenized, transaction volume, recurring fees, institutional customers, and share dilution. If those numbers improve, then DVLT may be positioned in front of a major structural shift. If they do not, the tokenization trend can be completely real while the investment thesis is still wrong. I think that distinction is extremely important. So let me bring this back to where we started in the late 1960s. Wall Street almost collapsed under the weight of physical stock certificates. The solution was to leave the certificates in trusted custody and move electronic ownership records instead. That helped create the modern stock market. In 1944, the dollar became the center of the global monetary system through Bretton Woods and gold convertibility. In 1971, the gold connection ended. But the dollar became even more powerful because the network of treasury markets, banks, and American securities surrounding it was more useful than the gold promise. It lost. Now another transition is beginning. Dollar cash is moving on-chain through stablecoins. Treasuries are moving on-chain. Stocks and ETFs are moving on-chain. Collateral is moving on-chain. And the institution that helped solve Wall Street's first ownership crisis is now helping build the infrastructure for the next one. When I first saw that QQQ had been tokenized, I thought it was another interesting experiment. Now, after connecting the stablecoin story, the Treasury story, and the DTCC story, I think it is much bigger. I think we may be watching the early construction of Dollar 3.0. Crypto was supposed to replace the dollar. Instead, it may distribute the dollar. Blockchain was supposed to eliminate Wall Street. Instead, it may upgrade Wall Street. Tokenization was supposed to remove trusted intermediaries. Instead, the largest trusted intermediaries may be the ones that finally make tokenization real. And honestly, I have been following this theme partly because of my investment in DVLT. There have been moments where I have wondered whether we are simply too early, whether these companies are building products for a market that does not exist yet. The July 15th DTCC event answered one question for me. The market is real. The largest institutions are no longer debating whether real assets can move on-chain. They are working on how to move them, which assets go first, which networks are approved, who controls the ownership record, and how those assets can be used inside the financial system. Now, the pressure moves to companies such as Datavault. The future they have been describing is beginning to arrive. The question is whether they can execute before the largest institutions capture everything. That is where I am right now. Bullish on the direction, interested in the opportunity, but still waiting for proof at the company level, because the next phase is not about who can tell the best tokenization story. It is about who can move real assets, collect real fees, and create real value for shareholders. Thank you for watching. This is GoGlides Finance. Subscribe if you want to keep connecting the headlines that look small today to the much larger financial system being built underneath them. And I will see you in the next one.